Good morning, everyone. So we are now on week number two. This is the video lecture. And then after this video lecture, I'll give you a rundown on a problem solving in Excel. And then after that one, you should be able to take the quiz. So we will have our first quiz after this week, and I'll post it on Canvas so you can actually log in. And then there's a time limit for that one, then submit. So every week, starting this week, or when you submit it, that will be next week. We will actually have weekly quizzes, and then there will be two assignments on the very tail end of the semester. Basically, in that will be sometime in November, late in December, a financial analysis assignment. So, but in between, mostly quizzes, as discussed in the syllabus, there will be 11 quizzes. I will drop like or I'm sorry, like 10 quizzes. I will drop one, so that's nine plus like two assignments, something to that effect. So today, or this for this week, we're gonna go through financial ratios. So let me go to the slide, and then I'll go through some of the ratios. We'll give some examples, and then another video for problem solving. Okay, so I'll share my screen. Okay, so we're gonna go to our, let me just move it here. We're gonna go through financial ratios, and then the first thing I wanted to discuss is actually something that we is actually important as a guide on why we do analysis and why we do measurements, right? So James Harrington, I think he passed away 2024. He's a quality assurance guy. He basically does a lot of training, and then he was quoted saying that measurement is the first step that leads to control and then eventually improvement. So if you could not measure something, you could not understand it. If you could not understand it, you could not control it. And if you could not control it, you could not improve it. So he really has a quality management point of view, right? Most of his career as a speaker, and then also for big corporations and whatnot. But this applies to, I always use this term in accounting, even in the graduate school, because everything starts with measuring things. And then if you measure something, either it's actually the performance of the company, or the performance of the company within its peers, or the performance of the company among its peers, and then within a, say, a group of industries, right? Then you would actually have a benchmark on how you perform, whether you're performing good or well, or actually you're a laggard. Are you leading? Are you lagging? And then how do you now go to a certain place? A strategic component of the business is always to grow, right? How do you grow now the business? So we will go through certain a quantitative calculation, which are the measurement parts that would actually help us do some benchmarking of our own performance as an entity amongst our peers and then amongst an industry. Okay, so basically that's what we're going to do now. So we're going to do now the calculation part. Now, we would actually be looking at certain financial ratios. We will focus on financial ratios that are important, like the DuPont method. We're going to go through that one. And then things that you can see both on your balance sheet and then also the income statement. Now, basically, there are classifications of financial ratios. You have the profitability ratio. By the word profitability, it measures how much is the margin per dollar of sale, per percentage of sale, and then also the return of the investment. So you have, this is where the acronyms comes in, right? You have ROA, return on asset, basically net income over the asset that you have invested on, then return on equity, net income over the equity or stockholders' equity of the business, then profit margin. Basically, that will be net income over sales. Or if it's actually gross profit margin, gross profit, which is sales minus cost of sale, gross profit divided by sales. So depending on the formula, you have those profitability ratios, right? Then you do have also utilization ratios. So profitability, think about it as a relationship with the income statement. And then the asset utilization ratio, knowing the word that there's asset, meaning that these are mostly balance sheet. I wanted to know how well do we perform as a company and collect receivables? How well do we perform and actually move our inventory? Do we move our inventory every month? Move meaning that I buy the inventory from a vendor, it comes to my warehouse, and then by the end of 1 month, it actually all is all out, meaning it's been sold and converted to receivables, then you would convert it again to cash, right? So basically that inventory turnover, turnover meaning how fast do you move the inventory? The faster, the better, meaning that you're selling it. Receivable turnover, the faster your turnover, it means the faster that you collect, basically. Fixed asset turnover, what is the, when you generate income from the business, how much of it is attributed to your fixed assets or your property, plant, and equipment? And of course, either it's a property, plant, and equipment, it's either receivables, it's either inventory, the turnover. When you combine most of it, it will be the total asset turnover. Now, there is also two other types of ratios. So a while ago, we have profitability, income statement, asset utilization, balance sheet. You have liquidity ratio. Liquidity ratio is mostly on balance sheet also. It actually tells you how fast or how liquid the company is, meaning that um, I was going to say liquid again. Do you have enough cash to liquidate or to settle or to pay your current liability? So it's mostly on current assets. Do you have enough current assets to pay for current liability? But why do we need to focus on current? Current means is that as of the balance sheet date, it needs to be collected if it's an asset, or paid or settled if it's a liability within 12 months as of the balance sheet date. So basically, if I have December 31, 2024, for example, I have a liability that I need to pay 12 months after that balance sheet date. So that's current liability. If I have current assets like receivable, I need to collect that within or less than 12 months as of the balance sheet date. So basically, those are current. If it exceeds more than 1 year or 12 months after the balance sheet date, then that will be considered as non-current. And then for all we know, in accounting or also in finance, if it's a non-current item, then it means that there will be a time value of money. Let's spark that idea later because we will have a discussion on the time value of money. And then that will be part of it, the discounting method. Now, the last ratio that we talk about is that the debt utilization ratio. So remember in week number one, we talk about if I'm a company, what are the two ways of doing financing? You had debt financing, and then you do have equity financing. So debt utilization ratio is basically saying that, hey, how much of my total asset is because I actually loaned or borrowed amount to finance my total asset? And then also, at the same time, debt utilization would also tell us, do I have enough money or net income to pay for interest expense? So that's the times interest earned. And then other fixed charges, do I have enough money on those other fixed charges that I can pay, say, the bank or whatnot, or the vendors? So it's a question on, am I able as a company pay my dues that are a long-term debt or debt obligations to third parties. So that's why it's another type of ratios. So they would say, okay, I get that for debt, but what about equity? Remember our discussion last week? If it's debt, you are mandated to pay, right? Obliged to pay in order to comply with your loan covenant, because if you sign for debt, you need to sign a loan covenant, a compliance document, saying that you're going to be paying on a monthly basis, semi-annual, or whatever requirements. And then if it's actually equity financing, you can tell your shareholders, I'm not going to declare dividends now. I will do it next year, depending on whether you have retained earnings or not. So a bit different between debt financing and equity financing. Just wanted to relate that from the last week discussion. Now, we will actually go through certain items on the ratios, and then we're going to go to the calculations, right? So, profitability ratios is the question on whether you have the ability to have adequate returns, right? It will be best explained on an example. So, asset utilization, we talk about turnover, like speed. How do I how what's is my turnover of accounts receivable fast? When I say turnover of accounts receivable, you convert it to cash. How fast do you collect? Inventory turnover. So it means that how fast can I actually sell inventory? And then when you sell the inventory, there's another step. If you, I would say flip, right? If I flip and then turn around or and then make a sale of the inventory, normally you would assume that your inventory was made on sales, right? A sales credit. And then now your inventory becomes receivable, and then receivable turnover, how fast do you collect that? So you have two stages now. Inventory sold on credit, it becomes receivable, then convert back to cash. So that's how you normally want to think about it, the conversion one, right? But for now, inventory is how fast you actually sell it from your warehouse all the way to the customer, then long-term assets. And then liquidity ratio really emphasizes, we talk about current ratio. Current ratio is basically current assets divided by current liability. Do you have the ability to pay for your current liability? So let's do it this way. If I have a current asset of $1 million and my current liability is $1 million, so current assets divided by current liability, both the million, is equals to 1. So it means that you have just enough for every dollar of liability you have, current liability you have a dollar of current asset to liquidate it, which is not good when you think about it, because normally a rule of thumb, right? So a rule of thumb meaning it's not super scientific, but like it's actually a rule of thumb that people use as practice. You should have twice as much current assets to accommodate and settle current liabilities if you need to. So it means that you need to have 2 million of assets divided by a million of liability to come up with 2 as a current asset, a current working capital ratio, right? And then that would mean that you have twice as much assets. For every $1 of liability, you have $2 of current assets. And then that is a better way because any contingency in the business, like say when COVID hit, a lot of companies would need to have enough cash in the bank in order for them to sustain the business as you go through paying the employees, even though there were no sales being collected. There were no new sales because of COVID, right? Depending on the business that you have, because most companies close shop and whatnot, but you still have employees to pay, or if you let go of the employees, you still have bills to pay, like your rent, who's actually there still, regardless of whether you're using it or not, and any other obligation that you might have incurred, including the current term of your liability with the bank. So something like that. Now, why are ratios important? So we talk about the ratios. The ratios are important on two things. It provides an insight on the performance of the company more than just reading the financial statements. So we looked at the financial statements last week, but this time around, other than looking at the numbers, let me now do ratios on the financial statement. And then you can do trending as well, which we'll be discussing on a separate video for this week. Um, and then what are the other users of the financial ratios? it will be a banker or a trade creditor. Because what happens? So at IPNE, where I work, we have, say, loans with the bank. And then every quarter, we send out a compliance report. So using our financial statements, the bank requires us to calculate certain ratios, particularly like if we're able to pay the debt that we have with the bank. So we need to show to them the times interest earned ratio, which we'll discuss later on, and then the fixed coverage ratio, which we will also discuss. And then if I show a number higher, say 11x or 11 times, then it would mean that I have enough net income to liquidate any interest owed to them 11 times. So if the higher is more than two or three, depending on your agreement with the bank, then it means that the bank would say, okay, I am safe. They are able to pay me. Because the reason why they loaned us money is because they would believe that we will be using it, that would generate income in the future for the company, and then we will be able to pay the bank. So the bank would always want to take a look on financial ratios. So we give to them financial ratios as we calculate every quarter. It's required in our loan covenant or loan agreement. Now, when you have bondholders, there's a consideration of, hey, what is your debt to asset ratio? Is it growing bigger? No, it's okay. Do you still have profitability? So those are the bondholders also important for them. And then of course, when you think about companies, wherein if you are a growing company and you would like to ask for investors, hey, can you invest to our company? So they would say, first, can you give me a copy of the financial statement? So if you work in finance, later on you will work in finance in an accounting department. And then if you are looking for potential investors for the company, first thing that they would ask is that, can you give me the most recent financial statement? And of course, 1 year of financial statement is not enough, right? They would say, can you give me the audited financial statements for the last 3 years? Most likely the relevant years, right? Um, as a side note, for example, COVID happened in 2020, 2021, right? So nobody wants to use those data because they know there are, during those years, is a lot of one-offs, a lot of things that did not happen well, and then that's not the normal performance of the company. But they would ask you 2022, 2023, and then what's happening right now, 2024. At the same time, that 3 years worth of data might not be your highest performance because you are, as a company, is basically trying to catch up with your what we call now pre-COVID. So when an investor asks us, "Hey, can you give us your performance or an indication of your performance pre-COVID?" So we always think about, okay, I'll give you 2019 data. So I will give them 2019 data so they understand how the business performs. It might be normally pre-COVID is higher than current right now, performance-wise, net income-wise, sales performance-wise, and then we will just give them the trend, right? Just something that you would want to consider, because what happened in 2020 and then 2021, even in 2022, early 2022, is actually COVID years. So those were challenging years. Now, we're going to be using Sexton as a ratio analysis for now. So basically, you have the income statement, then you have the balance sheet. We will compute both profitability, asset utilization, debt, and also some solvency ratios, right? As we discussed a while ago. So we're going to go down. Now, I would actually move it here. So the first thing is that is on the profitability ratio. Profitability ratio, you have here a profit margin. Profit margin, some people would say, hey, it's the gross profit margin. If it's a gross profit margin, it means we know it's actually sales minus cost of sales is gross profit. But here, it's only profit, not gross profit. So we're thinking it's actually net income. Okay. And then net income over sales is actually 5%. So how do we say this now? For every, let's make it relatable, right? So for every dollar that I would actually make as a revenue, as a sales, I would only get 5 cents as income. So that's the easiest way to remember things and then make it more relatable and make it more unitized. So when you say, hey, our profit margin is 5%, and then one way of saying it or one way of thinking it, if you're sitting on the board meeting, oh, okay, so for every dollar that the company makes, they actually make 5 cents, right? Or for every 500 every $100 you actually get like I say 5% of that one, or $5. So that's actually the way that you want to think about it. Now, return on asset is actually a calculation on net income. Okay, so I want to make sure that you can see it, right? So net income is this one. So I pull up net income divided by sales. So here, there is a notation that the sales are all on credit, meaning that the company does not have cash collected on sales. Why is that an important note? I'll show you later when we do the accounts receivable turnover. So I might be going back and forth class, okay? So bear with me if I go back and forth on the slides. So return on assets is basically, it's one calculation wherein is net income divided by total assets. Net income we know is 2 million. Let's make sure that we can trace this one to 1.6. I want to make sure it's actually something that we can trace. Total asset is a balance sheet account. I can actually see it here on total assets. Okay. So they use the word net assets. Why? Because there's net property, plant and equipment. Why is it net? Because it's actually property, plant and equipment less accumulated depreciation. Of course, they did not. The book did not say show it, but that's the reason why you netted it out with accumulated depreciation. So 1.6. We also know that asset is equals to liabilities plus equity. So liability 600,000, and then if you add both the equity account is 1 million. So this plus this plus this is equals to 1.6. So remember, asset is equals to liability plus equity, so 1.6. Okay, just want to make sure. Now, net income divided by total asset is 12.5%. So what we're trying to say is that the company's use of the asset. So how do you make money as a company? The company makes money by deploying assets that would generate revenue. So revenue generating assets. What are those things? If I have receivables or if I have inventory, I need to make a sale on it on profit. Okay. If I have equipment and then I use that equipment to produce the inventory, say manufacturing, I deploy those equipment to generate inventory that can be sold on profit, revenue generating assets. Now, IP&E is a gas station, so I deploy capital expenditure or investment to our retail sites. Either it's an upgrade on dispenser, like the machines that dispenses fuel, an upgrade on the building itself, an upgrade on whatever we have as an asset on the site. So those upgrades, those asset investment that you place on the site or on the ground or in production is generating 12.5% of net income at the end of the year. That's how we want to read a return on asset. So on an average, any asset that Saxton deploys on the ground or on the field is generating 12.5%. Now, we have just two calculation now. And then you would say, okay, internally, I computed and have 5% of profit margin and then 12.5% of return on asset. Is that a good thing or a bad thing? So think about it this way. You would only know that insight, if you compare it with a timeline, I would need to compare on a timeline of Saxton. Give me more than this is the current year. Give me the prior years. Is it actually improving or are we deteriorating? Are we leading or are we lagging within our company? The leading and lagging question, you now need to compare with an industry average. So this is Saxton. Even if we compare it with the time horizon of the same data for how many years, or the last 3 years, for example, I need to now know how am I performing? I need to measure, right? How am I performing against my peers in the business? So you would have industry average. Now, in the US, there's a lot of trade associations that actually provided by state. In Guam, where I sit right now, reside right now, and work right now, it's a bit challenging to get those data because there's not a lot of companies that are listed that provide data, right? So most of the companies in Guam are privately held, meaning they are not public, and then we don't trade stocks in the stock market, so we're not required to disclose data. But it's just why that's why it's a bit hard to get industry averages. If anything, we will get the data from Hawaii that might be comparable, but we still need to make sure that the size of the operation of a competitor that is on the same industry as us, we can use that as a benchmark because you need to make sure it's the same size, same industry, almost like for like. I would say almost because it's really hard to do a full an apple to apple comparison. Going back on profit margin, so the industry average is 6.7. I'm 5. Definitely, I'm not leading. I'm actually a bit behind, but how how is it bit behind? Is it way big or just like am I the last one? Maybe 5 is the lowest one, and then the rest are actually at 6. So that's why perspective is important, and data collection and competitive data gathering is actually important as well, right? So you can actually take a look on, if you don't have data, if you only have Saxton, then let me take a look on the last 3 years and compare it with industry average. But you should be able to have an indication on how your business or competitors are actually doing as well. Now, going back to return on asset, here, I have A, right? That's the first formula. The second formula, letter B, is almost the same. You can tell because it's the same 12.5%, but they did a different calculation. So net income, so here, return on assets, net income over total assets, right? Here's net income over sale, which is basically the profit margin. When you think about it, it's the same, right? This one is the same. And then also sales over total assets, which is actually revenue asset turnover against revenue, right? Formula here, sales cancel the other sales is just basically net income over total asset, which is which is basically the same as this one. Okay, so that's why it's going to be 12.5 still. Now, return on equity or ROE. ROE is a very famous ratio, an important ratio for most investors because it's basically net income divided by equity, stockholders' equity. So 200,000, which is the net income, we've been using the net income divided by stockholders' equity of 1 million. Let's see, where did we get stockholders' equity? We got it. So remember, stockholders' equity consists of two things: a capital, a capital, which is common stock or preferred common stock and preferred stock and retained earnings. In Saxton, we only have two. There's no preferred stock. It's common stock of 400 and 600 of retained earnings. So I need to add both. That's 1 million. Okay. So we're going to make sure we trace it back so we know how to compute it. So 200,000 divided by 1 million is 20%. Now, another way of doing it is actually having the return on assets. So return on asset is the 12.5, right? So it's nice way, it's here. Divided by 1 minus debt divided by asset. What is 1 minus debt? 1 minus, so one minus debt would actually be your, or debt over asset minus 1. Let's just, sorry, let me just do it that way. Debt divided by asset would actually be your debt ratio to total asset. If you have minus 1, it will be equity. Why? Because remember, asset equals liability plus equity. So if you take out the liability divided by asset, you actually have equity over there. Okay, so it becomes 20% still. So what does it tell us though? We generated income using our assets at 12.5% return on asset. The funding of those assets comes from equity. And then the investment made by stockholders, equity, right, generated 20%. Ah, so what's the difference between, again, equity compared to assets, return on assets? The equity investment by the stockholders generated 20% of income. The total assets deployed generated income at 12.5%. Something, that's one way of looking at the ratio. So just want to make sure that the relatability of the ratio to the balance sheet and income statement is important to understand. So I'll go to the next page. Now, there is a DuPont system. DuPont is a company. A DuPont, you might have seen that before. They are a large corporation that does a lot of chemicals, household, and then it's like end to end. It's like General Electric. If people still remember General Electric, because they delisted from the New York Stock Exchange at one point in time. But they're a big conglomerate of a lot of companies, lighting, equipment, turbine for airlines and whatnot, or for the aircraft, and then a lot of other things, right? Engineering, and then household and what consumer and commercial. So DuPont is also something like that, a company that does a lot of chemicals and other things that are being used in the household as a raw material, right? Now, they created what we call a DuPont system on analyzing return on equity. They basically broke it down. Now, they're looking at they're looking at a return on asset and leverage, and also the leverage on combining it, on analyzing. I'll go down to the next page so you can see it further. Let me do this one. Yeah. So the DuPont analysis or DuPont method, as other books would say, is the DuPont method of analyzing what? Return on equity. So we know that return on equity is basically what? Net income over stockholders' equity, correct? But the way that they would like, or the way that DuPont as a company did it is that they want to see it on a profitability, an asset turnover, and then the leveraging. So it will come to the return on equity. Now, what I did was I pulled out one more document that I actually included on our slide deck right now. This is coming from a different book. It's actually from Cambridge. I like the way they presented return on equity using DuPont analysis. So I'm gonna use that one for today. Oops. So let's make it easy here. Return on equity is basically net income over stockholders' equity. Now, you can see here that they're using average. Now, if a ratio shows the word average, it means that you're adding 2 years. Adding 2 years and dividing it by 2. So you would tell me like, okay, so what does it mean average stockholders equity? I'll go back to our example a while ago, okay, on Saxton. Okay, we'll go back. So how much again is stockholders equity on Saxton? It's a million, right? Million here is common stock over retained earnings. Now, it's only 1 year as of December 1, 2021. If I would use average, I will add both the amount here and then of last year. Last year will be prior year, so I'm gonna do the left. Yeah. Say 2020. As of December 31, 2020, stockholders' equity plus as of December 31, 2021, stockholders' equity divided by 2. What will happen is that normally your stockholders' equity would only move by net income, right? The net income factor. Why? Because it gets close to the retained earnings. And retained earnings is part of the stockholders' equity. If I divide it by 2, then you get to have the averaging. Yeah. So mostly the averaging happens on balance sheet items. Averaging does not happen to an income statement. Why? Remember, income statement is a period of time, right? A period of time. So January 1 to December 31. A balance sheet is a point in time as of December 31, as of December 31, 2020, as of December 31, 2021. But the income statement is from January 1 to December 31, 2021, a period of time. Okay. So you're using net income this much, but if you're dividing it with stockholders' equity, I need to do it on as of December 31 if it's stockholders' equity. But if the formula says use average, then I have this one, December 31, 2021 of stockholders' equity plus December 31, 2020 divided by 2. Okay. Just want to make sure that's clear because depending on the book that you would use, you would actually have two calculations. For our own purposes, unless I would mention that you would use the average, then you assume that it's always 1 year only for your balance sheet accounts, just to be sure. And then you would ask me, like, why do they do that? Why do they make it complicated? Averaging happens because you normalize something, but sometimes averaging might not work, especially during COVID year, right? Like there's super big balance sheet movements. You don't want to average that together with your post-COVID recovery because it thinks out the calculation. So just to give you an idea why, sometimes it works, sometimes it does not work. Now, return on equity is net income over stockholders' equity. I'll just say stockholders' equity for now, right? No averaging. Now, we also know that another way of doing it is net income or is return on asset, net income over total asset, multiplied by financial leverage, which is total asset divided by stockholders' equity. So, how much of the total assets were funded by equity as a strategy? So that's one thing that's actually being worked on. Now here, what happened now is that I have this, and then I have a return on equity or return on asset. So return on equity now, which is net income over average equity, you have that. And then we can break down this net income component into profitability and then productivity. You can break it down basically. What do I mean? The return on asset can be a profit margin, can be an operating expense margin, or gross profit or a profit margin. The return on asset can be the productivity of the assets that we deploy. We've learned that a while ago. The turnover of the assets, inventory, accounts payable, cash conversion cycle, which we'll discuss on the next slide, and then the fixed asset turnover. And then it's also on how you use your financial leverage. Financial leverage is basically this formula, assets over stockholders' equity. How much of the total assets that you have right now as a company was funded by stockholders' equity? So that's why the DuPont method considers a breakdown further of return on equity by looking at it on the return of the assets or net income over the assets, right? With the financial leverage strategy. So that's why you break it down. The return on assets is further broken down either as a profitability ratio or a asset utilization or productivity ratio. So that's why the DuPont method is actually more information. And then now we're going to go to the utilization formula, but I will do this one on the next slide or on the next video. So we will actually break it down. Okay. Thank you, everyone.